Good day, ladies and gentlemen. Welcome to Application Project 3, Summer 2020. This project is worth 15 points, or 15% of your grade. There's three distinct parts, and parts for each section are identified as in the past. It's due no later than 11:59 on June 25th, 2020. Do leave yourself enough time to do it. Don't wait. I'm going to review and grade them as submitted, hopefully. Submission format is PowerPoint. Do your work in Excel and copy paste into PowerPoint, or make sure you attach your Excel document. Use the notes section, and feel free. A number of you have used audio and video comments to explain things, and that is very helpful. If you are not sure what to do, please contact me for any help that you may need. If you want to do a discussion, a real-time discussion online, just let me know. It's a busy week, but I'm sure I could schedule it in. This covers everything that's been covered so far. This project should incorporate the prior two projects. Okay, make them as one document. Make sure you address the issues I brought up in the previous project so you don't lose any points on that. Have a logical organization. Everything around revenue in one spot. Use an index. Check your work. Did you address everything I brought up? Read the investor presentation and 10K management discussion again. Okay? It's there. Not integrating everything could cost you a negative penalty. Okay? So it's expected. Again, it's about quantitative and qualitative. Don't repeat definitions. I know what they mean. How we're going to be graded, very similar to the other ones. Organization and presentation, accuracy, clarity and depth. Again, this is a big one. And then our final one, the integration. How does one topic impact another? Part one. Historically, this section would have focused on the company's strategies for growing revenue in the future. So from a finance perspective, we want to look at what are the actions the company is engaging in to grow their revenue, and that will drive everything else around the company. However, coronavirus, COVID-19, has changed all of this, and it's changed it in ways that we couldn't even imagine. We have companies that are fighting for survival, whether that be a small business, medium business, large business. What we do know is that all companies will be faced with additional costs, providing a safe working environment, and an impact on revenue at all different levels. Let's just take a look at what's going on with the companies you're working on. Southwest, fighting survival. The revenue has gone down to almost nil. Commercial metals, slowing revenue. Home Depot and Advanced Part seem to be stable. So we're really going to look, Southwest is in survival mode, Commercial Metals is trying to stay focused, Home Depot and Advanced Auto Parts are going to say, well, how can we grow from this? The strategies they may have had come last February, the strategies they had as we started out the year are very different. They're not going to be able to implement them. So we're looking at the future. And the first thing any company needs to do to survive in the future is to be able to survive today. So what we're going to do is, the first part of this is to do a stress test on the financials of the company. The company's ability to survive is based on its financial strength. Do they have a balance sheet capacity to be able to absorb some of these losses? The steps in the process are: compare the cash flow from operations to the company's fixed payments as indicated in the 10K. So if you think about it, based on the historical results, they've been generating cash from operations, and that has to be used for the fixed payment expenses. Okay? Very similar to a coverage ratio that you looked at. But we're going to do this a little bit different. I'll show you in a moment. Okay. What you will find is I added a page on Steel Dynamics worksheet called Stress Test. And what we start with is, we're trying to see how the company will be able to withstand shock to its income statement, and then therefore based on its cash flow. Cash flow is used, we got to look at to cover fixed payments. So the first thing I did is I went to the cash flow from operations, and I went to the cash flow statement. I linked it here, and it was $1,396,000. Next thing I did is I looked for fixed payments. Now, fixed payments are in the 10K in the notes section, and it's a required disclosure today. And when we look at it, what I found was this: contractual obligations and other long-term liabilities. You need to go to the 10K, and they identify the total contractual payments that are due. This includes everything: long-term debt, interest, purchase obligations, constructions, everything they're locked into doing. And what I found for 2020 is $1,206,000. So I bring that over here, and if I subtract cash flow from take cash flow from operations, subtract the fixed payments, they have an excess of cash flow over fixed payments. So in that situation, they do have sufficient funds under assuming that this year comes in the same as last year, and that's good. We then take and stress this free cash flow from operations, reduce it by 25%, so there would be $1,047,000. The fixed payments don't change, but they're going to be $158 million short. Now, if we look at the 50% reduction, they're going to be $500 million short. So this is the first test. This is the stress part. We're stressing the cash flow from operations, and that is a key piece here. Based on 29, there's no significant impact. But if they lose between 25 and 50, what can they do? Decrease expenses to increase income, reduce current assets, cash, accounts receivable. How could they try to collect their accounts receivable faster? Can they reduce their inventory? Can they defer the account payable second? Can they draw on existing lines of credit? Do they need to raise more capital and more debt? The next question is, does the company have a line of credit they could draw upon? So if I go to the notes to the financial statement, 10K, I will be looking for long-term debt and a discussion on availability. And what I found is that the company entered into a new unsecured credit agreement with a senior unsecured revolving credit, which provides a $1.2 billion unsecured revolver. Okay, the amount outstanding of the company had $1.2 billion of availability. Okay, so it has plenty of money that if it needed to draw on that revolver, it would be able to. So that we could conclude is good. So that's the stress test that you should engage in. Step 2 is, what has the company said about the impact of COVID-19 and its impact on their financial sustainability? Summarize them. Okay, the most recent one that I found, you're going to go to the website of the company, and we're going to take a look at what we can find. So we're looking for fairly recent documentation that will talk about earnings that just occurred and they're reporting on, update to investors, or to provide guidance for the future. And on June 18th, which was just a couple days ago, they gave guidance. They said they're going to be profitable within this range. And they got some one-time items. Okay. They're going to be below. They tell us that. They say, oh yeah, but things are good. Now, what are they saying? Significant second quarter 2Q20 earnings significantly lower than sequential first quarter due to lower shipments and selling values. So volume and price went down. And that was because the users of steel went into hiatus for a point in time. they did note that construction-related demand has been steadier. So what we can see is they're giving us their view of what's going on and what they're doing. So now what we need to do, after you read that, create a summary. Here's what a summary could look like. Steel Dynamics said. Let's try to summarize that fairly succinctly. They have a very positive outlook. They provided second quarter guidance in the range, so they're going to be profitable. That we know. Temporary closures of steel-consuming customers result in lower sales. Recycling operations will have a loss. Construction remains stable, one of their big customer segments. Supply chain for auto manufacturers is starting back up. They have a strong order book, including back orders. So they're looking to think, yeah, they're going to be impacted. Second quarter is not going to be real good, but they're going to make it. And that's consistent if you look with some of the testing and the analytics that we've previously done on Steel Dynamics. The next thing we're going to do is take a look at the technicals. Now, this is discussed in Module 7 Equities as to how. So basically, we need a chart for 1 year and a chart for 3. Chart should be in the candlestick format, showing 50-day and 200-day moving average. Indicate the earnings release dates so we can see if there's any movement in the significant movement in the stock caused by earnings. Interpret what the trend is telling you. Here's an example of Steel Dynamics, and as we can see, here is the blue is the the 200-day moving average. The black is the 50-day. So what we can see is that over the past year, it's on a downward trend. Earnings announcements, as you can see, have not caused a major increase in the stock price. But what we're seeing is a slight movement up. So what I would say, it's been on a downward trend over the past year, as the 50-day moving average has been below the 200, blue being the 200, black being the 50-day. Earnings announcements, here, and here, have not had a material impact on the stock price. In the past 2 months, the stock has been trading slightly over the 50-day, but hitting resistance at the 200-day, with the 50-day providing support. Okay? Here's another example of it at the 3-year chart. The last part, 3 points, is 4. And that's where we sort of pull this all together. What's the current PE ratio? What is the forward? What are the estimated earnings per share for the next 3 years? What's the estimated price range for the stock price for next year? What is the median estimated stock price? Based on your review of the company and strategies that you have reviewed, is it reasonable? Explain why. Now, let's just take a look at how to come up with the current PE and what the forward PE is. Okay, the price to earnings ratio, PE, it's the price of the stock at a point in time divided by earnings per share, expressed as a number with 2 decimals. The resulting quotient is saying that for every dollar of earnings per share, how much is the market valuing the company? So the company is valued based on the multiple of earnings. And there's wide variations based on future earnings too. So we really have 2. It's the trailing PE, TTM, computed on 12 months trailing EPS, historical. Forward is computed on estimated earnings. So it's a ratio. We have both a numerator and a denominator. Where do you get the estimates? Well, if you go to the Wall Street Journal, you put in your stock symbol, and what you're going to do is you're actually going to come out with, here are the estimated earnings. Make sure you hit annual. See this thing here, annual? And this is the historical, and this is 2019, 20, and 21. So we can see the consensus for 19 is 302, and 262. If we look here, it's been going down. Okay, so we can compute the PE because we know the current price, and this is the future price. This piece here tells us that of the 13 analysts who are watching, okay, and studying STLD, 7 say hold it, 6 say buy it. When you look at it, it comes out as overweighted. Could be overrated too. And the stock price, you get a range from 33 to 46. 33 is the median, 34. So we can see that there is some increase in price potential based on what analysts are saying. So we get the information here, and then we present it like this, okay? And I list it. Here's my historical. I do the formula. 3182 divided by 535 is a PE of 595 and a forward PE of 1054. Now, that actually doesn't look bad. And when you think of the average and the current price, based on everything I see, I think the estimated earnings are reasonable based on the risks previously identified. Okay, so that's what, and again, it may appear that it's undervalued if you compare that to the market. But that's for a different course. This is how you summarize it.